Hi everyone, I'm Phyllis here from CPF Board. So thank you so much for joining us here today for our CPF and your retirement webinar. So whether you're just starting your career or well into your working years or even approaching retirement, understanding how CPF can act as a foundation to your retirement is actually important for building the retirement that you want. Okay, so tonight I'm going to share some tips to help you build that strong CPF foundation, and afterwards we'll take your questions. Okay, so let's dive in. Okay, so when we talk about retirement, we should think about what exactly we need in that stage of our lives, right? So for all of us in general, here are the three basic needs that we need in our retirement. So firstly, we have housing. So we have housing as a foundation so that we have security as we age in it and don't have to worry about rental expense. So as we approach retirement, it'll be best if our homes are fully paid up for so that we don't need to worry about mortgage or things like interest rates going up. Okay, then the next pillar we have healthcare. So as much as I hope that all of us, will be healthy and don't really have to touch this pool of funds, but the chances are as we grow older, uh, likely we'll have to spend a bit more on our healthcare needs lah, right? So this is also where MediShield Life comes in to provide the basic health insurance and help us pay for larger medical bills. And the last pillar, which is what I'm focusing on today, is retirement income. So ideally, we should have a steady stream of monthly income to pay for our daily expenses when we retire, such as your food and your transport, so that we don't have to worry about outliving our savings. And we will also need to have some savings that we can withdraw in case we have some immediate needs. Okay, just to share some interesting data with you. So we found that generally females have higher life expectancy than males, and our life expectancy has also been increasing for both genders. So this is according to the SingStat life expectancy for Singapore residents. For males, generally age 65, half of them are expected to live past 84. And for female age 65, 50% of us are expected to live past 87. And then when we talk about life expectancy and things like, when we talk about life expectancy, we also think of, oh, this links to how much retirement savings we need, right? Because like you don't know how long you live, so you don't know how much you need in your retirement. Yeah, so this also brings about two schools of thoughts lah. So the first one is like people usually think, oh, if I spend too much now, right? What if I live too long and I don't have enough to spend, right? But then on the other hand, we also have people thinking like, I worked so hard my whole life, but then I don't get to retire, I don't get to enjoy my retirement savings. That's also very tough. Yeah, so I'm going to present to you CPF Life. Okay, so with CPF Life, you don't need to worry. You can continue receiving retirement income no matter what age you live to. Okay, so CPF Life, which is short for CPF Lifelong Income for the Elderly, is a national longevity insurance annuity scheme that insures you against running out of your retirement savings by providing you with a monthly payout no matter how long you live. As compared to most private retirement income plans out there that only provide payouts for a limited period. Okay, and also unlike investment products which are meant to increase our wealth, insurance products help to protect us against life uncertainties. Yeah, so CPF Life is actually an insurance product and not an investment product. Okay, so you can think of it like how health insurance protects you against those unexpected medical costs, right? So CPF Life protects you against longevity risks, and CPF Life also provides assurance of monthly income for life so that you don't have to worry that you outlive your savings lah. Okay, so how does CPF Life work? So you see from here, at age 55, you will set aside your retirement sum, right? So your retirement sum is the amount of savings you set aside in your retirement account. So the more you put in, the higher your future monthly payouts. And then next in the timeline, we have age 65. So at age 65, if you have at least 60,000 in your retirement account, you will be automatically included in CPF Life, and you can start your payouts anytime between age 65 to age 70. Okay, but if let's say you don't choose a plan at age 70, you will automatically be placed on the standard plan and the payouts will start automatically lah. Okay, so just for illustration purposes, let's say you start at 65, okay? So, okay, at 65, you go to the CPF website, then you indicate you want to start the CPF Life payouts. So you receive your payouts all the way every month. Uh, Firstly, from your retirement savings, you can see the retirement savings bar going down, right? And then even when your savings are fully exhausted, you will still receive monthly payouts, as you can see from here. Okay, so CPF Life gives you the certainty that even after your retirement savings deplete, you will still get a monthly payout. Okay, and then we come to this slide, which is most people's favorite slide. Okay, you can take a screenshot if you want to for your own reference. Okay, so if for example, for illustration purposes, if your goal is to receive a monthly payout of about $1,600, right? This is the amount that you actually need in your retirement account savings at age 55 and age 65. Okay, so why are we looking at these two ages specifically? That's because at age 55, that's when you set aside your retirement sum. And then at age 65, that's where you choose to start these CPF Life monthly retirement payouts. So with the power of compounding interest and the interest rate earned over the 10 years, CPF Life will help you grow your retirement savings to help you achieve this desired payout lah. Okay. And then, of course, encourage you to set aside your retirement sum earlier so that it can earn good interest and also grow to a larger sum at age 65 with the power of compounding. So if you set aside the this year's FRS of 213,000. Okay, sorry. If you set aside your retirement sum earlier at 55, you only need the full retirement sum of 213,800, which will grow to this amount here on the screen, 319,400 in 10 years' time. So that's almost like 100,000 increase. Yeah, so this will give you your desired monthly payout of about 1,006 to 1,007. Okay, and then good news is your CPF savings earn pretty good interest in the respective accounts to help you achieve those figures earlier, right? So you can see for those of us who are below age 55, we have OA, SA, and MA at the respective interest rates. And then when we are below 55, we also enjoy an extra 1% interest on the first 60,000 of our combined CPF balances. Okay, and for those of us who are above 55, the retirement account will be created for us at age 55, and the interest rate for retirement account is 4%, same as the special account. Okay, so for those of us who are age 55 and above, we get an extra 2% interest per annum on the first 30,000 and an extra 1% interest per annum on the next 30,000 of our combined CPF savings. Okay, so this means that you can actually earn up to 6% interest per annum on your CPF savings. Okay, so this might be a bit hard to understand like that. I will give an example to illustrate. Okay, okay. So as an example, for example, you just turned 55, and then your retirement account savings is at 88,000. Okay, so the first 30,000 will earn 6% interest. So remember the extra 2% interest per annum, right, on the first 30,000. Then next 30,000 will earn extra 1% interest. So that will be 5%. Okay, and the rest of the 28,000 will then earn the base interest of 4%. Yeah, so this the interest rate helps you grow your CPF savings for retirement, and your desired retirement payouts are also determined by the amount of savings that you can set aside in your retirement account lah. Okay, and for those of us who are turning age 55, there are two things that happen when you turn 55. Okay, so the first thing that happens is your retirement account will be created. Okay, so your special account savings are actually meant to contribute to your retirement payouts. So we will first transfer the savings from your special account, and if it's not enough, we will also transfer savings from your ordinary account to your retirement account up to your FRS. Okay, so if there's any excess savings in the special account, they will be transferred to the ordinary account, and then the special account will be closed. Okay, and then from here, sorry, the second thing that happens at age 55 is you can also withdraw your CPF savings. Okay, so regardless of whether you have met the full retirement sum, you can withdraw the first 5,000 from your OA or your SA, and any excess savings if you have hit the full retirement sum lah, with no conditions. Okay, you can still withdraw your CPF savings at any time from age 55. You don't need to withdraw at 55 if let's say you don't need it. Yeah, some of us let's say we don't have an immediate need for this fund, right? We actually just leave it in the ordinary account to let it earn 2.5% interest lah. Okay, so in the event that you have less than your FRS, so for example, you have 125,000 in your OA and SA, then in this case, 120,000 will be transferred to your RA, and then you can withdraw the remaining 5,000. Okay? And if you have less than your BRS, then you can still withdraw up to 5%. So you can still withdraw up to $5,000. Okay. So essentially, the more you have in your retirement account, it translates to a higher future monthly payout lah. Okay, and if let's say you have an immediate need, right, you need to make a higher lump sum withdrawal, you can also withdraw your retirement account savings above your BRS if you own a property that has a remaining list that can cover you up to at least age 95. Okay, so this means that after you set aside your BRS, you can still withdraw another 13,500 from your retirement account on top of this $5,000 in the OA here. Okay, so for members who own a property in Singapore with remaining lease that lasts them until at least age 95, you have this flexibility to meet your FRS with a mixture of your property and cash, and you can withdraw your RE savings down to BRS using your property. Okay, and then this is also a very important point when you think about retirement, because inflation and the rising of cost of living is a very huge thing, right? So, from year to year, the prices of goods keep increasing. So, while the price increase may not be very obvious if you compare last year and this year, but the thing is, I guess for most of us, retirement takes place over a longer period of time. We are saying maybe 10, 20, 30 years. I don't know. Yeah, but it's like a longer period of time. So the impact of the rising prices is actually very significant, right? So imagine like maybe 10 years ago, we pay $2 for a tray of eggs. But nowadays, it's like when I go to the supermarket, I need to pay like $4 plus for a tray of eggs. Yeah, so inflation is very real. Yeah, and it eats away at our purchasing power. So uh, once you have a better idea of how much you need in your future years in retirement, you will also be able to better select a CPF Life plan for yourself lah. Okay, so there are three plans for CPF Life plan. For CPF Life. Okay, so firstly we have the escalating plan. So for those of us who are worried about things getting more expensive in the years ahead and need an retirement income that increases every year, this is CPF Life escalating plans, which provides payout that increase 2% each year. Okay, so the next one we have standard plan. So if you prefer to keep within a fixed budget, which may mean that you have to lower your lifestyle to buy less things as things get more expensive in the years ahead, then you can choose standard plan. It gives a more stable monthly payout. And lastly, we have basic plan. So if you can lower your lifestyle to buy even lesser with progressively lower payouts in the future, then the legacy basic plan is good enough. So the monthly payouts under basic plan are lower and will get progressively lower when your combined balances eventually fall below 60,000 lah. This is because as we shared earlier, remember the extra interest? Yeah, so the extra interest earned in your retirement account are are paid as part of your monthly payouts, which will decline when your balances fall and your balances fall. Mm. So one thing to highlight is your choice of plan depends on what you value. So there's no best CPF life plan. Okay. So also all three plans allow you to enjoy the interest earned and the CPF life premium balance together with any remaining CPF savings upon death, which will be transferred to your beneficiaries lah. So since we don't know how long we'll live, the expected bequest is also irrelevant when we consider our choice of a suitable CPF life plan lah. Okay, so how CPF Life provides payouts for life. So firstly, your retirement account savings will be deducted as CPF Life premium when you join CPF Life. Okay, So your CPF Life payouts are first paid from your life premium, and then when the premium is depleted, you will still continue to receive the monthly payouts from the interest that you and other CPF Life members have accumulated no matter how long you live. Okay, so your CPF Life premium will still continue to earn CPF interest rates. Okay, and this interest is also factored into your CPF Life monthly payouts, which will last as long as you live. So there won't be any like losing out on interest. And then when you pass away, we will pay your CPF Life premium balance together with any remaining CPF savings to your beneficiaries. And the interest in your CPF Life premium that has not been paid to you is pooled and goes towards providing monthly payouts for surviving CPF Life members lah. So this is part and parcel of risk pooling, which is similar to other types of insurance out there. And this ensures that all CPF Life members can receive payouts for as long as they live. Okay, so now I've covered CPF Life. Now we are going into 3 tips to enjoy higher lifelong monthly payouts in your retirement. Okay, I'll give you 3 tips. So, firstly, reduce your CPF outflow. Okay, so as mentioned earlier, it would be best if your home is fully paid up for, so you don't need to worry about mortgage in your retirement. Or if not, you can consider using part CPF, part cash for your mortgage payments. Okay, and then second is if let's say you can't find an investment vehicle to pay that pays you as well as the special account at 4% interest, then maybe don't use your CPF savings to invest lah. And the last one is if you do not have to withdraw all your withdrawal savings at one go. Okay, so you can consider if let's say you don't need this money, you can consider just leaving it in the CPF in your CPF accounts for to earn the interest lah, which is quite high as compared to banks outside also. But if let's say you feel like oh you suddenly need this money, then yeah, you of course you can withdraw. Okay, to boost your savings through top up. So to enjoy higher monthly payouts, you can also consider topping up your SA if you are below age 55 and to your RA if you are 55 and above. So if you are below 55, the maximum you can top up to your SA is the current FRS, which is 213,000. And if you are 55 and above, the top ups can only be made to your retirement account, and the maximum amount is at our current enhanced retirement sum this year, which is 426,000. Okay, but note that these top up monies are purely for the purpose of building up your retirement savings, okay? And retirement savings and also increasing your monthly payout. So they can't be withdrawn in lump sum. Okay. And yes, your ERS is now 2 times of the full retirement sum, so that it allows us to top up more to our retirement account for higher CPF monthly payouts. And the full retirement sum remains unchanged at 2 times of the BRS. Okay, so from 2025, members with withdrawable special account savings channeled to the ordinary account when the special account is closed can also consider transferring these savings to their retirement account to earn the long-term retirement account interest rate, which is higher than the OA lah. OA is at 2.5%, RA is at 4%. Yeah, so this will also help you to receive higher payouts because the interest rate rose faster the interest rate rose at a higher rate, right? Yeah. Okay, and then when you top up with cash, you can also get tax relief. Okay, so for cash top ups to yourself, you're eligible for up to $8,000 tax relief when you top up for yourself, and then another $8,000 if you top up to your loved ones and help them to build up their retirement savings. Okay, but this is only up to the full retirement sum. So note that any cash top up from your full retirement sum to your enhanced retirement sum, they do not enjoy tax relief. Okay. And we also have the match retirement savings scheme. So for eligible seniors who should have received their letters, like if let's say you're eligible for this, uh, they are those who have yet attained their basic retirement sum in their retirement account. So the government will match the cash top-ups to these members, matching dollar for dollar, up to $2,000 in a year and 20,000 over a lifetime. Okay, so while the top up for MRSS will not enjoy tax relief, you can still enjoy tax relief on those top up that don't attract this MRSS lah. Don't attract the MRSS grant. And apart from cash top ups, you can also transfer your OA savings. Okay, so you can do a CPF transfer from your OA to either your SA or your RA, depending on whether you're below or above 55 and above. Yeah, but make sure you just plan carefully lah, because these transfers are not reversible. So make sure that the money that you transfer over is those that you don't need for, your housing installments. Okay, and CPF transfers also don't have tax relief. Okay. So the tip number three is to start your payouts later. So if let's say you don't need these funds, right, you can actually consider deferring your payouts to boost your retirement savings. So you have the option to start your payout from 65 to 70, right? So you can actually defer until age 70 if let's say you don't need this payout lah. So for each year that you defer, your payouts can increase by up to 7%, and this will translate to higher monthly payouts when you decide to start receiving your payouts. So for example, if you choose to start your payout at age 65 under CPF Life Standard Plan, you will be receiving around $1,600 a month. And if you defer and start at age 70 instead, you will instead receive about maybe $2,100 every month for life. Okay? So you don't even have to do anything. You can just sit back and let just enjoy the power of compound interest. Okay, so to consider the retirement income you want, first thing you have to think about is your uh consider your desired retirement lifestyle. Yeah, so think about a retirement lifestyle you want. Just now we talked about inflation also. Yeah, so once you have an idea of about how much you need for your years in retirement, you can better choose a CPF plan that suits yourself lah. Okay, so like we mentioned just now, there are three plans: escalating plan, standard plan, and basic plan. Okay, and next you can also work out the monthly payouts and premiums that you need. Okay, so to estimate this, you can estimate the amount of monthly payouts you need to support your retirement lifestyle you want using the monthly payout estimator tool. Later, I'll also share this retirement payout planner in the next slide. It's a QR code. Then you can make use of that to plan your retirement payout also. And also, the last point is determine if your retirement savings are enough, right? So, are you short on your CPF savings to pay the premiums required for your chosen CPF Life plan? Or you can also boost your savings by making cash top ups or doing CPF transfers to your retirement account. Yeah. So, hopefully, with the tips that I've shared with you, you can get a head start to your retirement and one step closer to your own retirement goals. Okay. So yes, this is the slide I was talking about. So this is the QR code to our retirement payout planner. You can use this to estimate your monthly retirement income based on your desired retirement lifestyle. Okay, I will move on to my last few slides. Okay, so nowadays scams are so prevalent, right? Like we used to generalize that, or only like maybe the slightly older folks would get scammed, or maybe like scammers would tend to target like older folks. But nowadays it's not true. Scammers are just becoming smarter and targeting everybody. Yeah. So we just want to highlight that CPF board officers will never ask you to review your CPF balances, transfer funds to them, or provide your banking credentials. Okay, so you can take a photo or a screenshot of this page to see like our valid telephone calls, email addresses, and SMSs that which we will only send from gov.sg. Okay, so make sure the email you'll see properly, because nowadays they always like to replace the gov, right? That's G0V. Yeah, so make sure it's GOV. Okay, so you can also scan the QR code on the screen. It leads you to our to ScamShield website. So ScamShield is also where you can report if let's say there's a suspected scam, right? You can also report it there. And these are our new anti-scam security measures that are available to CPF members. So the default withdrawal limit is $2,000 for online withdrawals for CPF members age 55 and above. And this can also be adjusted to up to $50,000. But if let's say you're scared that scam that it might be I don't know, sorry. If let's say like you want to be safer, you can also disable this online withdrawals instantly lah. So activate the CPF withdrawal lock and set it to 0. And then in that case, CPF withdrawals can be done in person at CPF service centers. Or if let's say you want to increase your daily limit again, make sure you plan ahead so that there's this 12-hour cooling period. So that you can wait for this 12-hour cooling period, then after that you do the withdrawal. Okay, and take note that there's also a 12-hour cooling period for changing or adding contact details and also bank account details. Okay, and then with that, I will wrap up my sharing. Yeah, so thank you for listening attentively to my session. This is a QR code on the screen which leads to our Plan with CPF. So Plan with CPF is our one-stop portal with CPF planners and resources to help you optimize your financial decisions. For example, planning for your home purchase, your healthcare financing, and also your legacy planning. Okay, then these are our socials. You can connect with us here. And if let's say you found today's session useful and you wish to share your knowledge with your peers and others in the community, we invite you to join as our CPF volunteer. Okay, so you can just scan the QR code on the screen and you can download the CPFV app to join us. Okay, with that, I will hand the time over back to Jeremy.
Thanks so much, Phyllis. It was really, really informative. I myself learned a lot as well. And I was actually one of the volunteers at the CPF Ready for Life Festival recently. So definitely worthwhile for anyone who's interested to check it out. It was very fulfilling. All right, so for me, I'm going to jump into the SRS section. So it's, the theme, of course, is around saving for retirement, which again, I think both the CPF and SRS are designed around. But there's, of course, a lot of big differences. And so hopefully I'll cover some of the ones that are the most meaningful today. The SRS is the Supplementary Retirement Scheme. It's a voluntary contribution, as I mentioned, for everyone, Singapore citizens, PRs, but also foreigners residing in Singapore. So essentially, as long as you pay taxes in Singapore, you can participate in this program. If you're a citizen or PR, you can contribute up to $15,300 each year. If you're a foreigner, you can contribute up to $35,700. And the reason for this, the rationale is really because foreigners don't really get the CPF, so they can't save for retirement using CPF. And the SRS is designed to help them, accumulate a bit more for retirement if they want to retire here. The main advantage of the SRS is really around savings taxes. Any money that you contribute into the SRS scheme is tax deductible, which means you don't need to pay taxes on them this year. You can also really enjoy paying much less taxes on them when you do withdraw them in the future, which I'll go into a bit of a deeper detail. If you deposited your first SRS deposit before 2022 June, you can withdraw it when you're 62. If you deposit it today or anytime before June 30th, 2026, you can withdraw it when you're 63 years old. And after that, you can withdraw it when you're 64. Of course, that might change. The 64 might change in the future, but the 62 and 63 are kind of set in stone. Withdrawals are also given a 50% tax concession, which means that whatever amount you withdraw each year, you only need to pay taxes on 50% of that, which is, of course, incredibly attractive. And I'll run through some of the math to show you how much you could save. So if you're earning $150,000 as a Singaporean and PR, you would typically, have some personal reliefs, your CPF contributions, maybe topping up for yourself and your loved ones. And if you contribute $15,300, the full SRS amount, using these assumptions, you can actually save quite significantly on your tax bill, up to $1,760 each month. Each year. So this is quite significant. If you're a foreigner, you're also earning 150,000, but you don't have that much deductibles because again, you don't have the CPF contribution, but you're contributing the entire $35,700 to SRS. You can save $5,156 each year. There are many ways to contribute as well. You can contribute on a monthly basis or on an annual basis on a lump sum. If you're very conscientious, you might do it in January. If you're a bit lazier, you might do it towards the end of the year, or you can just set it up and just contribute $1,275 each month if you're a Singaporean and PR. So let's talk a bit more around these tax concessions, and we'll keep it simple before we talk about compounding, etc., by having a very simple case. right? Rachel, she's contributing it for 20 years, starting when she's 43 up till she's 63, where she can start withdrawing her SRS. So she will contribute $306,000 over the 20 years. She has a couple of options to withdraw once she reaches that age. She can withdraw everything in one lump sum, or she can stagger those withdrawals over 10 years. In the vast majority of cases, it's advisable to stagger those withdrawals because that has major implications on the taxes that you need to pay. So there are certain restrictions on withdrawals. For the premature withdrawals, if you withdraw it before you reach the retirement age, you are allowed to do so, but you have to pay a penalty, and that penalty is quite steep. You have to pay a 5% penalty on the amount, as well as 100% of taxes on the withdrawn amount as well. So you would essentially is never a good idea if you can avoid it to have to premature withdraw your SRS funds. If you do wait until you're the right age, your retirement age to withdraw it, you only pay 50% of taxes on that. The SRS account as well, once it's been fully closed, you've withdrawn everything, you cannot reopen it as well. There are a few other caveats, such as if you withdraw it some before maturity and you pay the penalty, you can continue topping up, after you've kind of gone through that experience. So let's talk a bit more around how you can strategize the maximum amount of taxes you can save with SRS. Assuming that you've actually accumulated $400,000 in your bank account, in your SRS account. Over 10 years, you can withdraw $40,000 each year, which reduces your taxable amount to only $20,000. Remember, it's 50% of what you're withdrawing for that year. And because $20,000 is below the taxable income cap that we have in Singapore, you actually pay $0 for the taxes on the amounts you withdraw over the 10 years. Of course, if you withdraw $400,000 at one shot in a lump sum, there'll be substantial taxes there. So now let's bring in a little bit more complication around investing and compounding. As I shared, unlike CPF, the investment and the interest, in a sense, of SRS is not great. If you leave it in the cash account in your bank, it makes 0.05%. So we need to find a way in order to keep our SRS competitive and able to support our retirement. So again, using the example of Rachel earlier, where she's been saving diligently for 20 years. If she's only kept it in a safe deposit, she's going to get $306,000 or $307,000 if you count the 0.05% interest. However, assuming that she invested in a well-diversified, broad-based, equity-based investment, and she earns I'd say, a reasonable 8% of return each year, over those 20 years, as long as she contributes the $15,300 consistently each year, she's actually able to build up a total retirement wealth of $700,000, which would then give her a very comfortable way to retire. Of that amount, she would only need to pay $3,750 in taxes. This is pretty amazing because for $700,000, you're dividing that amount and withdrawing that over 10 years, and you're only paying 50% on each of this 10% that you're withdrawing each year. So what this means is that you're only paying taxes on $35,000 each year, and at today's tax rate, that's only $375. Over 10 years, that's a total of $3,750. So there's also one additional very important thing in that the taxes that you save today can also be invested and can also contribute towards your retirement savings. So the amount of taxes that you save over the 20 years is actually worth $35,200. Remember, each year that you use the SRS, assuming you're earning $150,000 and you have $40,000 of deductibles, you're saving $1,760 in taxes. Assuming that you're investing that, again, in broad-based equity, earning 8% each year, you actually grow that amount to $88,744. After deducting the $3,750 you need to pay in taxes once you actually withdraw it, it leaves you with $85,000. So the takeaway here is very simple. If you set aside the funds diligently in an SRS scheme, you invest it again diligently over 20 years, you actually are able to save $85,000 of value in taxes and build up a nest egg of $700,000 for you to retire comfortably. Next, we talk a bit about the foreigner side of things. So again, we're going to use a shorter period of time, 10 years. And for foreigners, if you actually do this for 10 years, you're able to withdraw penalty-free after 10 years as well, with certain caveats. If you're kind of setting aside the full amount of $35,700, and you're growing again at that 8% compounding value each year, you'll accumulate 517,000 once in 10 years' time. This could be because you're 53 years old today and you're saving up to your 63, or you might be younger, but then you plan to leave Singapore after 10 years. So this is where a bit of the complexity comes in. There are two options. If you are a foreigner and you are here until you're at the retirement age of 63, you can follow the same scheme and withdraw your SRS over 10 years. The $517,000 that you have will be divided by over 10, because again, you're withdrawing it over 10 years, and will be halved as well. So you only pay taxes on the $25,900 that you withdraw each year. And that only comes up to $120, which is $1,200 over the 10-year period. So very reasonable. However, if you haven't reached the retirement age of 63, you might be 53 or 43. After 10 years, the government does give you the option of withdrawing the SRS in one lump sum. You have to withdraw all of it at once. You cannot split it out into 10 years if you haven't reached the retirement age. If you do this, there are no penalties, but by withdrawing all of it in one lump sum, you actually have to pay a significant amount in taxes. So it's still 50%, but because the total amount you're withdrawing in one shot is $517,000, $258,000 is taxable, which comes up to around $32,000. However, at the end of the day, it's still a good idea to do SRS. You've saved $51,560 over 10 years by taking advantage of SRS. And again, if you're investing that diligently, you've grown it to around $75,000. The value of the taxes that you save, regardless of whether you do the 10-year withdrawal when you're 63, or you do the lump sum withdrawal after 10 years, regardless of your age at that point in time, are still significant. If you do it the 10 years plan, you save, or you gain the value of $73,000 in taxes saved, while if you've done the lump sum withdrawal, you still have a value of $42,000. So let's move on and talk a bit around what to do with SRS. As I said, one of the big differences between CPF and SRS is the CPF gives you great interest rates, 2.5% to 6%. However, the SRS does not. SRS in the bank gives you 0.05%, which is essentially, not very significant. And so it's really important for you to grow your SRS investments in order to keep pace with inflation. Let's talk again about Rachel. She's again diligently saved up $15,300 for 20 years, but she's made a big mistake and she didn't invest it. She left it in the bank, and she earns 0.05% interest over 20 years, which brings her total amount out to $307,000. However, as again, my CPF partners have mentioned, inflation is a real concern and is a real threat to retirement. And at inflation rates of, let's say, 2 or even 3% each year, assuming an inflation rate of 3%, the real value of this money actually falls significantly down to $23,300. This might actually offset most of the tax savings you have. So if you're kind of setting aside your SRS already, and shielding that from taxes, don't kind of lose that value you've gained from saving taxes, and don't lose it to inflation. For Jermaine, she's a bit more astute. She's done the same thing for 20 years, saved diligently, but she's also invested that. And as we've seen earlier in the compounding growth graph, if she's done that, in a broad-based, a low risk, kind of a lower risk equity broad-based investments, and growing at 8% each year, she can actually grow that retirement sum to $700,000. Even factoring an inflation rate of 3%, this is still $500,000, which is very comfortable for retirement, especially when you add it to the CPF retirement schemes as well. So, what should you do with your SRS? So, my view is really that SRS is designed for long-term investing. You cannot easily withdraw it before you're retired anyway without paying the penalties. So, you should really invest thinking about the long term. If you're still many years from retirement, 30 plus years from retirement, 20 plus years from retirement, you can consider putting that in, say, in slight risk-adjusted investments that actually give you a higher rate of return over time. Because you're leaving it there for 10, 20, or 30 years, the volatility matters a bit less, but the total returns over the period matter more. And so by kind of investing in these broad-based diversified equities, for example, you're able to accumulate and grow your retirement funds over this long period. Of course, if you're approaching retirement, you're already, in your 50s or close to 60s, you don't have that much more time before you reach the actual retirement age. You might want to be a bit more conservative to make sure that you have enough set aside to live the retirement lifestyle that you want. And therefore, you might choose to maybe go into something a bit safer, like bonds, Singapore government bonds, for example, treasury bills, etc. So you can SRS is a bit more flexible than the CPF, again, because the CPF already offers you such amazing interest rates. In the SRS, you can actually have quite a wide variety of investment options. You can invest in stocks and ETFs, you can invest in government bonds, fixed deposits, as well as managed portfolios like those at StashAway. And ultimately, it really depends on your horizon, right? So if you want to really set a budget and decide on your risk tolerance as well, as I shared, if you're still 20, 30 years away from retirement, your risk tolerance can certainly be higher. If you're 5, 10 years from retirement, you might want to be much more conservative and just make sure that you reach that retirement goal that you have set aside for yourself, to make sure that you can live the life that you plan for. So, to wrap things up, I'm going to debunk some of the SRS myths. So, the very first one is that SRS is only for Singaporeans and is only for Singaporeans or only for foreigners, and it's not, right? It's for everyone. As long as you pay taxes to the government in Singapore, you're eligible for the supplementary retirement scheme. Now, other people are saying I'm too young to be eligible or to start with an SRS account. So anyone above the age of 18 can open an SRS account and start saving. The caveat here is, of course, if you're, earning, not that much, the value of SRS is probably also not that high, because you're not saving that much on taxes. So I say if you're earning above a certain amount, you're paying a certain amount of taxes, that's when the SRS becomes very valuable. The third myth is that you can have multiple SRS accounts, and that's not true. You can only have one. You can pick which of the 3 big local banks to set up in. But once you've kind of set up your SRS there, you can make your investments using your SRS funds in a variety of platforms. The fourth one is around incurring a penalty when you withdraw your SRS investments. So you will only incur the penalty if you withdraw it early, right? So if you draw it before you reach the retirement age of 63, then you will face the penalty. So the key here is really planning ahead. If you expect to, upgrade your house or buy a car, and you know that you won't have enough cash flow to afford that, then you probably want to defer your investments in SRS until after you've kind of made those life purchases. However, as a rule of thumb, it's generally advisable to set aside some money on your SRS as much as you can, because of the tax savings that it provides you. So we're always happy to share a bit more about SRS, the best ways to kind of manage your wealth and make sure you retire comfortably. And so you can always reach out to us by scanning the QR code or emailing us at the bottom, and we're happy to talk through a bit more around any questions or details that you might want. So yeah, thank you again for joining me today. And I hope it was helpful and educational. And I hope this also inspires you to start investing and start setting aside your funds in SRS and investing those funds today as well.